Last year, the Los Angeles wildfires became the most expensive wildfire in history, about $40 billion in insured losses. So you'd think the price of insurance behind the scenes would spike. It did the opposite. This year it got cheaper. That makes no sense, until you see who is actually holding the risk.
I spent 30 years pricing catastrophe. And here is the thing almost no one outside the industry understands. When your house burns, your insurance company usually isn't the one that pays the biggest share. There's a second hidden layer of companies above yours, and a layer of investors above them. Today we follow $1 of risk all the way up. Because the answer to why is my policy so expensive lives at the top of that chain, not the bottom.
Okay, so who insures the insurance companies?
That is exactly the right question, and it has an answer with a name: reinsurance. Your insurer is not a bottomless vault. It collects premiums from thousands of homeowners and hopes a whole city doesn't burn in 1 week. When the risk gets bigger than it can survive alone, it buys its own insurance from a reinsurer. Insurance for insurance companies. Here's the chain. You pay your insurer. Your insurer, the cedent, hands a slice of that risk and a slice of your premium up to a reinsurer. The giants here are names you rarely see: Munich Re, Swiss Re. They pool risk from all over the planet. So a wildfire in California, a typhoon in Japan, and a flood in Germany can balance each other out.
So my premium is partly going to a company in Munich or Zurich.
Partly, yes, but the chain doesn't stop there. Because even the reinsurers don't want to hold all of it. So they do the same thing your insurer did. They buy their own coverage. That's called retrocession. A reinsurer's reinsurance. And at the very top of the chain, the risk gets turned into something you can buy and sell on a market, a bond. It's called a catastrophe bond. An insurer or reinsurer bundles up a specific danger, say, a Florida hurricane, and sells it to investors as a bond. The investors collect a fat interest coupon, year after year, for taking that risk. But if the hurricane hits and crosses a trigger, they don't just lose the interest. They lose the principal, and that money goes to pay the claims.
Wait, so investors are basically betting on whether a disaster happens?
That is precisely the bet. If the disaster stays away, they win a high yield. If it comes, they fund the recovery. And here is who those investors are: pension funds, hedge funds. The money managing a school teacher's retirement can end up quietly backstopping a hurricane in Florida. That's the top of the chain. Your premium started at your kitchen table, and it ends in the capital markets of the world. Now look at the size of this hidden machine. Brokers put the world's total reinsurance capital near $770 billion. The catastrophe bond market alone hit a record $61 billion outstanding last year, after a record $25.5 billion in brand new bonds in a single year. And it has to be that big, because the disasters keep getting bigger. 2025 was the 6th year in a row that insured catastrophe losses passed $100 billion worldwide. A $100 billion year used to be a shock. Now it's the baseline.
So with the LA fires on top of all that, the price went down?
It did, and this is the strangest part of the whole story. The year the LA fires set a record, the catastrophe bond investors barely felt it. Fitch estimated their losses came in under $250 million against a market of $60 billion. So more money poured in, chasing those high coupons. And at the start of this year, reinsurance prices fell about 12%, even with the biggest wildfire loss in history fresh on the books. When this much capital is hunting catastrophe, the price of risk goes down, not up. So here is what this means for the number on your bill. Your premium doesn't really move with your own house. It moves with this global market, the price reinsurers charge, the appetite of investors half a world away. That's why your rate can jump in a year you never filed a claim. You're not just insuring your home, you're plugged into a worldwide market for disaster.
But wait, in the California episode, you said the state wouldn't even let insurers charge for reinsurance. Did that change?
It did, and that's the direct link. At the end of 2024, California finally let insurers pass the cost of reinsurance into your rate, the first time ever, in exchange for writing more policies in fire country. So this global chain we just walked, the one that stayed invisible in California premiums for decades, it just got switched on, which means understanding it isn't academic anymore, it's on your bill now. One piece of this deserves its own story. Those catastrophe bonds, the Wall Street bet on disaster, and what happens the day one of them actually blows up. That's coming on Uninsurable. But first on the MATR, rate base, the single number that quietly decides your electric bill. I'm Marcus Reeve. I spent 30 years reading the fine print.
And I'm Nora Vance. Turns out my insurance company has an insurance company.